So the market would move from 1140 down to 1007. So what that means is, out of the 140 pips, we now have 133 available. Now you have to remember, when the market is trading up here, when it's bouncing around, so let's kind of follow this. The market trades up, comes down, trades up again, comes down, trades up again. And we're looking to go short right in here. We say, okay, I'm going to go down to the 15-minute bar. I'm going to look for a 3-bar reversal. And we're just pretending here. I don't know what it actually reversed at, but we're pretending that we got the signal to go short at 1140. Since we've measured out the day, we know that we have 133 pips available for the day. Right? So we come back here to our handy-dandy expectancy formula. And now let's just keep this 133 in mind, so I'll put it right here. So we know, okay, I've got 133 pips left of today's range. What would happen if, instead of 85, now we go up to 95? Okay, you can see it starts shifting quite a bit. And again, we're not taking all of that profit. But here's the key. Again, some of you may be thinking, yeah, but we don't know if it's going to get there. We have no idea if it's going to if it's going to keep moving down or if it's going to move up. Here's what I'm getting at. What if that only happened 40% of the time? What if it only happened 45 or 50? Think about that. What if only half of the time it went 95 pips? Okay, so basically, in other words, what I'm saying is, you got out a little bit early, and the market was moving towards this 133 pip level. So, the market trades around, moves up, and starts to come down. So you take your profits at 95 pips, because you know, okay, I've only got 133 pips left for the day. I don't want to get greedy, and I'm just going to take my 95 pips and run. What if that only happens 40, 45, 50% of the time? Hopefully now you're kind of getting a feel for the power of this expectancy. So let's kind of go through the example again, and just to make sure that you've got the concept here. So what we did is we took the average range of 140 pips, and we simply looked at where the high of the day was. And remember, this blue line is right at 5 o'clock. So based on the high price, and remember, we don't know if that's the high of the day. It worked out that it was, but in essence what we're doing here is we're saying at the time that we're getting into the trade, we see that the market is making this move here. And we're thinking to ourselves, you know what, the pound's moved up quite a bit. It's at the top end of its trading range, or its trading lane on the daily bars. And yeah, I know that the market's in an uptrend short term, it's in an uptrend mid-term, it's in an uptrend long term. But if it's going to reverse, it's got to reverse sometime, so let me take a crack at it. And you're then saying, well, you know what? If this is the high of the day, and it's an average day, meaning 140 pips, then it will move down here. So you can see what I've done is I've divided the day, or the range, into these 3 sections. So we've got, here would be the top third, there's the middle third, and then here's the bottom third. So can you see that by shorting it up, by selling it up here, you're selling it in the top 1/3 of the day. So you've got a big move to the downside, which means then you can think to yourself, let's bring back the expectancy, you can think to yourself, okay, maybe I'm not just going to take 70 or 80 pips here. Maybe I will take 95 pips because the market is in the top 1/3 of the day. See, you see how now we're not guessing